With the current volatility in the crypto market, everyone's looking to capitalize. But can the DR trading strategy work for cryptocurrencies like Ethereum? Let's find out as we break down the top 7 DR basic trades from last week. Number 7, Ethereum versus the US dollar, Saturday's regular DR session trade. Yes, you heard that right, Ethereum versus the US dollar on a Saturday's regular DR session. Interestingly, Ethereum had already delivered some solid DR basic trade opportunities during the aftermarket and overnight DR sessions earlier that day. But let's focus on the regular DR session. The session began with a red DR box followed by a long confirmation. This shifts our focus toward long setups, though with lower expectations, as the DR upside model had already been broken when the regular DR session opened below the overnight DR session. Looking to the left, there was only one previous DR session level from earlier in the week that aligned with the current regular DR session. It's a key level to watch and highlight for reference. Price retraced but showed no clear rejection from either the DR highs or the mid-level. Instead, it dropped straight into the retirement setup area, perfectly aligned with the previous DR session level. This presented a valid entry, with stops placed below the defining range, as is standard in a retirement setup. There was no need to aim for the +1 standard deviation level. The overnight DR session lows already offered a clean 3R trade opportunity. Ethereum is proving to be an incredible asset for DR trading, especially with its current volatility. Don't underestimate the potential it brings. Check it out on your own charts. Last week's price action might indeed surprise you. Number 6, S&P 500 futures, Wednesday's overnight into regular DR session advanced trade. This is an advanced DR trade, but with consistent study and connecting the dots, even the basic DR concepts I share on this channel can help you spot opportunities like this. Looking at the bigger picture, the overnight DR session had just ended, fully respecting the aftermarket DR session levels, which confirmed that the DR downside model remained intact. During the ODR, there were two notable trade opportunities. A short after two IDR mid-rejections, which unfortunately ended in a loss, and another short after an ADR low rejection and retirement setup, which would likely close as a break-even trade if exited at the session's end. As the regular DR session opens, the DR downside model is still intact, meaning the RDR would need to take out the ODR highs to break this model. The opening candle rejects both the ADR lows and the ODR highs, setting the stage for further downside. While there are no intraday gap imbalances, several volume imbalances are stacked in the same area, providing additional confluence for downside moves. An early trade at this point would require a stop loss above the ODR highs, targeting the ODR lows as a minimum with further downside in line with the DR downside model. Since the defining range hasn't formed yet, you don't have precise standard deviation level targets, but looking to the left, we see the previous day's regular DR session lows and two open volume imbalances that haven't been rebalanced yet. Once in the trade and with probabilities already in your favor, the next step is waiting for the defining range to form. With the range completed, the confirmation candle immediately follows, aligning perfectly with the DR downside model. At this point, several confluences support further downside. The DR downside model remains intact. The RDR box is red with a short confirmation. The plus 0.5 SD level has already been reached, and the plus 1 SD level aligns with the open volume imbalances, providing a solid target. At this stage, the trade is already highly rewarding. You can decide whether to hold the position or take profits, but it's definitely wise to at least trail your stop to break even. The session ends with price extending beyond 1.5 standard deviations, fully capitalizing on the DR downside model. Trades like these require practice, study, and a solid understanding of the DR trading strategy, but with time you will develop the ability to recognize and execute them effectively. Number 5, US dollar versus the Japanese yen, Monday's overnight DR session trade. This one's a textbook example of how patience and precision can pay off. The session started with a green DR box, but a short confirmation occurred within the first hour after the defining range had formed. If you've been following my top 7 trade series, you'll know how valuable these recurring setups are. They repeat themselves week after week. With the DR upside model intact, Expectations for lower targets should be managed carefully. The ADR levels act as a barrier for price, meaning the lower you aim, the lower your probability. However, one key target stands out: the 2 standard deviation level, a frequent target when short confirmations occur within the first hour after the DR box has formed in the US dollar versus the Japanese yen. It aligns perfectly with the aftermarket DR highs, providing an additional confluence. To the left, we have 2 previous DR levels, one from the previous week and another from the previous day's regular DR session. These serve as key areas to watch. After identifying the targets, it is time to wait for a retracement back into the defining range. Later in the session, price rejected the opening price to the pip, perfectly aligning with the previous DR session level. A push higher created an opportunity worth considering. With stops placed just above the first previous DR level and the target set at the 2 standard deviation level, this trade offered a clean 3R setup. And if stopped out, no problem. You could wait for a deeper retracement into the range while keeping the same targets intact. Price retraced slightly higher, rejected the opening price again, and finally dropped lower. It didn't just stop at the initial target, it broke through all ADR levels and extended all the way to the +5 standard deviation level. What a banger of a trade! Keep refining your ability to spot these recurring patterns, and opportunities like this will always be within reach. Number 4. Euro versus the Australian dollar, Monday's overnight DR session, aggressive approach. This overnight DR session gave us an aggressive but calculated trade opportunity. Let's break it down together. First, the ADR and ODR relationship hinted strongly at a potential DR upside model formation. The ODR respected all ADR levels and closed above them, which is exactly what we want to see when considering longs. Next, we had a green DR box and an immediate long confirmation right after. These 2 elements alone increased the probability of continued upward movement significantly. Looking at previous price action, there were 2 previous DR session levels lining up perfectly with the current defining range. Always mark these, they're critical and can guide decision making throughout the session. Now, here's where things get interesting. Price retraced back into the defining range but wasted no time, quickly pushing back above it. The following candles began rejecting the defining range high, with the closing price of the range providing support just below. Even though this setup might seem aggressive, it was worth considering. Why? We have a clear DR upside model intact, the green DR box and long confirmation are already in place, and price has already reached the +0.5 standard deviation level. With all these elements lining up, it was reasonable to assume that the maximum retracement had already occurred, and the next target would be the next standard deviation level of 1. If this setup didn't work out and stopped you out, waiting for clear rejections deeper within the range for a second entry would have been the next step. Price steadily moved higher, reaching the 1 standard deviation level by the session's end, hitting the target. This trade demonstrates the importance of recognizing and trusting aligned probabilities, even in aggressive setups. Remember, preparation combined with these small details is what keeps you steps ahead in the market. Number 3, Euro FX futures, Tuesday's aftermarket to overnight DR session. The Tuesday overnight DR session on the Euro FX futures offered a textbook example of how preparation and confluence can lead to high probability trades. The day began with a strong aftermarket DR session trade opportunity, as price rejected the DR highs and reached the 1 standard deviation level. As the overnight DR session opened above the aftermarket DR, it signaled a potential DR upside model forming. The overnight DR session closed with a green DR box and the session confirmed longs almost immediately. This quick confirmation significantly increased the probabilities of seeing further upside price action throughout the session. Let's check for any volume and gap imbalances. First of all, intraday gap imbalances from the aftermarket DR session aligned with the current range. In terms of volume imbalances, we highlight those from the previous day's regular DR session and the current session. Toggle them on and off as needed. Looking further left, multiple previous DR session levels from earlier price action lined up with the overnight DR. These are crucial areas to highlight, as they remain important levels for markets. Lastly, there's an open volume imbalance from the previous day's regular DR session. This imbalance acts as a strong confluence, often serving as a magnet for price. Price retraced back into the defining range and initially rejected the IDR high. Sitting just below this level were two previous DR session levels and the closing price, an area to definitely cover with stops. What else supported the setup? With the retracement, a new open volume imbalance was created, adding further conviction for a potential long trade. This setup offered a clean trade opportunity. Stops could be placed below key levels, while the target aligned with the plus 1.5 standard deviation level, offering more than 3R. And if the trade failed, you already had the next probability zone deeper into the range, stacked with confluences around the retirement setup area. As the session progressed, price made its move. All targets were met and the preparation once again paid off, keeping you steps ahead of the market. With the DR strategy, being prepared isn't just helpful, it's essential. Number 2, Nasdaq Tuesday's overnight DR session trade. First, as always, we start by identifying the current DR model. Here it's clear. Price opened above the aftermarket DR session and respected all ADR levels, signaling a DR upside model. The box color? Red. But remember, with a long confirmation, the focus shifts to looking for trades in the confirmed direction. Next, we look for volume and gap imbalances that align with the current defining range. In this case, there are no gap imbalances, but we have several small but significant volume imbalances. One open WIB is just below the +1 standard deviation level, while another sits slightly higher. These tiny, almost invisible details often act as magnets for price, so don't overlook them. They can be game changers for decision-making, stop-loss placement, and targets. Looking to the left, we highlight previous DR session levels. Two levels perfectly align with the current defining range, covering it entirely. To keep the chart clean, we remember them mentally and toggle them on and off when necessary. Now that everything is in place, it's time to wait for a retracement back into the DR with clear rejections from high probability areas. Price retraces lower into the range, showing a solid rejection near the IDR mid and several previous volume imbalances. A trade opportunity presents itself here, but the setup offers less than 3 Rs. Not worth the risk, so we skip it. Price retraces again, offering a better entry. This time, after making a new high, it retraces even deeper, resulting in the first position being stopped out. But here's where things get interesting. Last chance for the session, price rejects the IDR low to the tick, aligning beautifully with the previous volume imbalance and settling perfectly into the retirement setup area. A clean potential 3R trade, targeting the +1 SD level and aligning with the DR upside model and long confirmation. Even with one position stopped out, this session showcases the power of preparation, patience, and using multiple confluences to stack the odds in your favor. A textbook DR upside model trade. Let's move on to the next. And we're coming to number 1, which is the light crude oil futures, Monday's overnight DR session. First, we identify the DR model to understand where price is currently located. Here it's clear a DR downside model is intact. Interestingly, the overnight DR session closed with a green DR box followed by an immediate long confirmation. This puts us in a position to look for long trades, but there's a catch. With the DR downside model intact, we must be extremely selective with targets. Why? The ADR levels will act as barriers for price. The higher you aim, the lower your probability becomes. This DR model constellation should by now be familiar if you've watched my previous videos. Now let's highlight volume and gap imbalances. There's one intraday gap imbalance from an earlier week's price action. Why is it important? It acted as a no trespassing area here and since then hasn't been revisited until this week's price action. I can quickly zoom into this area to show you before going back to the current defining range. There's also another one created right before the ODR session. In terms of volume imbalances, we have one from the previous day's regular DR session and several more created before and during the current overnight DR session. Lastly, we highlight previous DR session levels. These right here align with the current defining range and could serve as crucial areas of interest. Price retraces back into the defining range and shows a strong rejection of the DR highs in line with the previous DR session level. This sets up a great trade opportunity, but unfortunately price retraces deeper into the range, stopping out the position. With the next candle, price steps into the retirement setup area, rejecting the opening price and a previous intraday gap imbalance with sharp precision. Another potential trade? Not quite. The setup offers less than 3 hours, so patience is key. While price retraces one more time, probabilities remain the same. Finally, this setup offers a clean 3-hour trade targeting the ADR lows, a perfect second bullet for the session. Price reaches the ADR low target but struggles to push deeper into the aftermarket defining range. Look closely, price fails to close above the ADR low, showing multiple clear rejections. This indicates that the DR downside model is being respected and it's time to secure profits. Nothing random here, just the power of preparation and confluences working in sync. As always, make sure to like and subscribe, and I hope to see you in the next video.
We're gonna take on the world.